Zacks Screen of the Week, an overview of a timely stock screening strategy aimed at helping you produce more profitable investing results. This time around, we're going to screen for your stock's earnings yield with Kevin Matris, top stock screener, head of our Research Wizard division here at Zacks.com. Now, I've heard about this, but I've been watching the markets for a while. There may be people out there who haven't heard about earnings yield. And since it's part of the core work that we do here, give us a little rundown. What is earnings yield?
Well, a stock's earnings yield measures just that. It is the anticipated yield or return an investment in a stock could give you based on the earnings and the price that you paid for the stock. Okay. So first off, the calculation is inverse of the PE ratio. So check this out. First off, the PE ratio is price divided by earnings. So a stock trading at a price of 35, for example, with earnings of $3, that has a PE ratio of 11.67, which means it's selling at 11.67 times its earnings. Another way of looking at this is saying that you're paying $11.67 for every $1 of earnings, okay? Right. Now, when you look at the earnings yield, you calculate the earnings yield by looking at the earnings divided by the price, so it's opposite. Using the same example, a stock with $3 of earnings, trading at a price of $35, the calculation is 3 divided by 35, that has an earnings yield of 8.57%. The earnings yield, also known as the EP ratio, is expressed as a percentage, so a yield of 8.57% means you're earning 8.57 cents for every $1 of investment.
So how's this most commonly used?
Well, the way most people will use it, and the way I think you should use it, is you want to compare it to other stocks. But what people will do to be able to see if a stock is undervalued or overvalued is they will typically compare it to the yield on a 10-year T-bill. So conventional wisdom has it that if the yield on the stock market, the S&P for example, is lower than the yield on the 10-year Treasury, then stocks might be considered overvalued. By the way, the yield right now on the 10-year is 3.71%. So if the yield on the S&P is greater than the 10-year T-bill, stocks would be considered undervalued. And if it's lower, then it would be considered overvalued. The theory behind this is that bonds and stocks are both competing for investors' cash. To attract investment interest in stocks, there has to be a higher yield paid to stocks to make up for the additional risk that somebody would be taking to get into stocks in the first place. So the way this works is if earnings go up, the yield goes up. If earnings go down, so does the yield. Prices also affect the yield as well. If prices go up, the yield goes down, and if prices go down, the yield goes up. But essentially, stocks should have a higher yield for that investment because you are taking risk by getting into stocks, and that is why it should be higher because it is basically risk-free when you are getting into a treasury.
That yield is as of March the 16th, by the way.
Yeah.
So do I correctly understand that some people also use this to forecast the market downturn back in '07?
Yeah, here's what's pretty interesting. If you were to look at the yield on the 10-year T-bill in June of 2007, that's kind of when the market really started to, show some chinks in its armor. The yield on the 10-year back then was 4.95%. The earnings yield, though, on the S&P 500 back then was 4.19. So not much of a risk premium on that investment. And basically, if earnings yield on a stock is below the T-bill rate, that is when you say stocks are overvalued, and it clearly was, because shortly after that, you really started to see stocks falter, and that is when this whole big slide really started to take place.
Yields were kind of out of whack at the market bottom in '09 too, right?
Yeah, it was the complete opposite. So you saw the yield on the S&P 500 under the 10-year in June of 2007, but then they were way over the 10-year yield in March of 2009. So, in fact, I think you and I talked about this back in March of 2009. At that time, the earnings yield on the S&P was 9.51%. The 10-year at that point was 2.89. So with yields well above the 10-year, conventional wisdom said that stocks were way undervalued. Now, stocks could have gotten even more undervalued, but they didn't. Basically, the stock market began one of the largest rallies we have ever seen in the history of the stock market. Currently, as I said, the 10-year T-bill is 3.71%. The S&P, though, the yield is 7.01%. So it's off of the 9.5 that we had seen back in March of 2009, but there's still a pretty good risk premium paid to people in stocks to be able to attract that money. So stocks are still considered to be the more attractive investment.
All right, quickly, the parameters.
Yeah, the screen that I'm looking at today is I'm looking at companies that are trading over $5 a share. The volume is over 100,000 shares on a daily basis. I'm looking for companies with an earnings yield of greater than or equals to 5%. Now, if you wanted to narrow your screen down even more, I think I got like maybe 70 companies through the screen. If you wanted to narrow it down more, you'd probably want to look for companies with an earnings yield of greater than that 7%, which is what the S&P is showing right now. But either way, looking at an earnings yield of greater than 5%, I want the 12-month projected growth rate to be greater than 10%, and I'm also applying this to companies that have a Zacks rank of a number 1.
And highlight some stocks that came through the screen.
Yeah, the 5 stocks that came through, you've got Carlisle Companies, Cisco Systems, Molex, a jeweler, Signet Jewelers, and then Whirlpool. All good-looking companies. They all have a great Zacks rank, all have good growth rates, but more importantly, they all have earnings yields that are very, very attractive, and I think they have good payouts on those.
Do you own any of those?
None of those.
All right. There is a text version of this screen of the week. You can access it on our homepage at Zacks.com by clicking on the headline next to Kevin's picture. And if you want to know more about the Research Wizard, the tool that Kevin uses to achieve all of these screens, Zacks.com/Research Wizard is where you should go online. With Kevin Matris and the screen of the week, I'm Terry Ruffalo.